Hello and welcome to the Technology Risk and Gambling webinar series. We're very pleased to have everyone with us today. If you haven't already sent us information about our upcoming Early Career Researcher and Student Showcase, that's coming up in a couple of weeks now. So if you know an early career researcher or a student who would like to be featured on the TRG, please send myself and Kahlil an email with their details. But today we're really excited to talk about what was actually one of the topics of our very first TRG webinars, which is the role of financial institutions and banking in terms of gambling. So I'm really pleased to have an expert on this topic, and I'm going to hand over to my co-host, Kahlil Philander.
Well, thank you very much, Sally. And I'm very excited about this guest because we've been trying to get her on for a couple of years now, and she's finally agreed to come on to the show today. So Naomi Muggleton, who is an assistant professor at the Warwick Business School at the University of Warwick, has written a very interesting study on the association between gambling and financial, social, and health outcomes, and using a very unique methodology, which is something that we'll get into today, as well as a few other topics, I'm sure. But for now, welcome, Naomi. Thanks for joining us.
Thanks so much for having me. It's so lovely to be here with both of you to be able to talk about gambling and technology.
Well, that's great. So one of the things, when I first read your paper, that really struck me was you, early on in the paper, kind of made the point that what you were focusing on in your contribution was something that was very different from the typical prevalence study that we use to look at these types of topics. So my first question is, why do you hate prevalence studies so much?
I don't hate prevalence studies. In fact, I'm working on a piece at the moment. I've just had a meeting a moment ago where we were devising our next piece of work where we're using the prevalence study. I think there are a lot of challenges with having people recruited in the traditional way in which, I'm a psychologist, and the way in which psychologists and practitioners tend to do research. And one of the real challenges is that you can only test so many people in the lab or online. And what this has meant, certainly in the UK, is that there has been a huge focus on sort of triaging. So in a world where you have finite resources and finite time, what are you going to do? Often you're going to disproportionately test individuals from certain demographics. That might be the people who gamble the most. It might be a certain subset, say younger people. And of course, there are representative samples, but there's a real challenge about being able to scale that up to get a sense of a large community of people. Now, what's so great about having a bank, and in particular the UK's largest retail bank, providing the data, is that you really can scale this up to a really large level. And for things that are particularly rare, in particular, it's helpful to be able to identify things within the data. But I think stepping back from that, what was really interesting to us as a question was, can you identify harms just from bank data? So by giving prevalence surveys and other types of questionnaires, there's an assumption that you need to have people be accessible and be open to you and report. And this was a way of unobtrusively following people who might not be on the radar. In the initial case, it was so that the bank could help to detect individuals who might be vulnerable. And you can imagine in scenarios where you can't ask people questions, this might be a way to go to additionally diagnose people who are potentially at risk.
And I really want to get into what you found. But first, I want a little bit of background, if that's okay, because you have what I believe is fairly unique, in fact, potentially completely unique in accessing large-scale bank data to do this study, which is something that hasn't been done, I'm aware of, unless you can correct me there. So can you take me through the background of how this study came to be?
Yeah, I guess my background is quite unusual because I have had various jobs in industry. So I've worked for sort of technological company. I've worked for, worked as a management consultant for a while, with a focus on finance, worked in investment bank, worked in a retail bank. So I've come at the academic route in quite an unusual way. And I think that with the type of data providers that I work with, it's quite helpful that I know how to sort of speak that language. So when it comes to talking to retail banks or to different organizations in business, I think that helps me to think about what the mutually beneficial things might be, and also to maybe step back a little bit and think about what the big picture is. I think an occupational hazard that I sometimes fall into is that we think about very specific questions and we go into the detail and we spend a long time before we come up with an answer that we're ready to kind of share. But I think from my prior experience, I was able to kind of think about ways in which I can kind of engage with stakeholders in industry. So that's kind of the longer term direction of travel. In terms of accessing the specific data, I became a postdoc on a project which was with Lloyds Bank, which meant that I had to become an employee of the bank. It actually meant I had to set up my own company so that I was a sole trader who then could work at the bank. It was a lot of faff to go around, but it was quite risky because there was a risk that when the data is provided by an industry partner, if they don't like the findings or if they think that there's a reputational risk, there was a concern that maybe certain projects might get pulled, or senior leadership might change their mind about publishing. And that's quite a risky strategy as a postdoc, when to get your next job you need to be publishing. But to their credit, Lloyds were really fantastic and supportive, and by keeping in mind what their goals were and what their sensitivities were, we were able to kind of find mutually interesting questions. And I think the gambling project was the most risky one for them reputationally. They didn't know how it was going to be received, and luckily it was received well in the media, and I think Lloyds were happy with the press coverage, but there was certainly a risk there. So finding a way to manage the relationship is something that maybe some of my colleagues, when I've told them I've had access to, haven't kind of appreciated. And, their first question is, well, how can I access the data? Unfortunately, it was quite a complex relationship, thinking about what questions we both would find interesting and what we were both comfortable with on both sides of the relationship. But once that was kind of baked in, we were able to access the data, do the analysis, and then ultimately come out with the paper. So yeah, it was unlike any other project I've done before, where traditionally you have ownership of all the data on your local machine and you off you go. So yeah, it was an unusual one, but the data are so lucrative that financial institutions have, that it was such a great opportunity that we just really wanted to be able to seize it, and we were lucky that we were able to.
And so with the data itself, would you mind talking a little bit about, one, how you sort of operationalize the inferences around gambling behavior in the data, and then two, how you operationalize the sort of lifestyle pieces that went into the way that you're drawing those associations?
Yeah, I think we realized really early on in when I was using the data with my colleagues that there is so much that you can tell about an individual from their bank statement. And I often think, if you were to look at, like a sort of detective, or maybe somebody who's thinking about a prospective date or something for you or for your friend, if you could just see the bank statement that somebody had, it used to hit the doormat once a month, now it's on your app, you can tell so much about a person. You can tell from the type of shops they go to, you can tell from whether they're a sort of morning person or a night owl, whether they're an extrovert who's going to the club, or whether they're somebody who's racking up library fines. I mean, there's so much you can tell about a person. And I think we realized that we could really go beyond just understanding financial outcomes, which are important, but are just a facet of somebody. So what we tried to do is we knew we wanted to look at gambling for this paper. So we tried a few different variables before the analysis, but we thought that probably the proportion that you spend each month on gambling relative to your other expenditure is probably a good measure, because that's sort of the attention that you're giving to it in your sort of basket of goods each month. And then with the other measures, of which I think there are 31, we went through the various repositories of data and also consulted with lots of people in the bank who had been working on these data sets for years and years. And we hand constructed lots of different variables. So we thought, for instance, in the UK, most people pay for their prescriptions, and it's a standard amount. Whether you're buying a really cheap drug or a really expensive drug, it's a set amount. So we went about looking at pharmacy spend that was of that amount or multiples of that number. So let's say it was £9, changes every year. We'd look for £18 and £27 and things like that. And you're able to see that people are buying prescriptions. For other things like shopping in certain places, it was quite straightforward. So if you had a payday loan, we could just see if you spent money to a payday loan. Or if we were looking at things like spend on off licenses, that was quite straightforward. But some of them required a bit more construction. So for things like nights awake, we looked for indicators that somebody might be an insomniac by looking at whether they were awake between, I think it was 1 a.m. and 6 a.m. buying stuff, because that suggests that you're not asleep, but you're, on your phone purchasing things from Amazon or wherever. So we went around the data and constructed lots of different variables, and we made a decision early on that everything we tested would go in the paper. We weren't going to just cherry pick the sort of sexy findings. If we found that there were positives, negatives, no effect, we would put them in the paper. And from there, we started to build up a taxonomy. I don't think it's perfect because it's quite segmented. And I think it would be nice if there was a way to kind of cluster these more formally, rather than using our intuition to say that looks like it's spend on health and that looks like it's spend on leisure. But what we really wanted to do was give a broad perspective of the person. So that's why we've got 31 really different measures, from the kind of social well-being all the way up to kind of financial distress.
And for the gambling variables, what did you do to construct that? Because my understanding is that a lot of gambling in the UK is still cash-based.
Yeah, it's definitely something that we were cognizant of. So any of the estimates and the effect sizes that we have are, if anything, an underestimation of the associations. In terms of cash, we did look at people using ATMs. I don't know if that's the same phrase that you would use in other countries, but a sort of cash machine. There's some nodding, so that's good. So we looked at how much people were taking out as an indication, because you'd have to take the cash out from somewhere. The other thing that we can't see is if you go to the supermarket and you buy a scratch card or a lottery ticket. So if anything, we're underestimating the effects. But yeah, it would be great to be able to see cash. Unfortunately, we just see sort of online or paying in shop with your card.
And would you think that you're underestimating a little bit too because of unbanked people?
Yeah, for sure. So we did a calculation somewhere in the paper where we looked at the proportion of people who are unbanked. It's a small proportion, but it's definitely a number that's there, and it's also going to disproportionately affect certain groups as well. So probably people lower socioeconomic status are more likely to be unbanked, and with the cash, it's more likely to be individuals who are older who are less likely to be on the app, on apps. So something I noticed, I was still at the bank when COVID kicked off. And one thing I noticed was there was this artificial spike where it looked like older people were gambling so much more than everyone else. But it was just that they had got the app for the first time, because they'd always in the past gone to the shop and paid in cash. Now they couldn't do that. They had to either not gamble or get an app. So I think that's sort of those people we wouldn't have seen in this sort of pre-COVID age. So yeah, it's something that we were aware of as a limitation, not being able to see cash or unbanked individuals.
And so your paper is obviously available, but for those who haven't read it yet, we'll put it in the show notes. But can you talk us through what you did find, or what you consider the more significant findings?
Yeah, so we found that the amount that people spend relative to their income, the amount they spend more generally, is associated with a variety of outcomes. And we didn't necessarily have strong priors. I'm not somebody who comes from a gambling research background who has positive or negative priors. So we were quite surprised to find how consistent our findings were. So we found that all levels of gambling were associated with higher levels of financial distress, lower levels of financial planning. Sorry, my lights are just coming off in my office. It's a little late here in the UK. And we also found that individuals had lower measures for leisure, socializing, health, well-being. And what really surprised me is of the 31 measures that we looked at, all but 2 were associated with harm, gambling. So for a really wide array of outcomes. And at the most extreme levels of harm, we found that higher levels of gambling were associated with future disability for people who weren't previously disabled, higher levels of future unemployment, and higher risk of mortality in the next 5 years. But I think the most interesting finding for me was that there was a continuum of harm. So a lot of the debate is around whether or not we should think about problem gamblers and responsible gamblers, or whether we should think about a public health approach where there's more of a continuum of harm. And what we find is evidence that supports the latter. Now, that isn't to say that I or my co-authors, not that I would speak for them, but I don't think any of us are abolitionists. I certainly am not. The way I think about it is being perhaps similar to driving a car or fast food. So fast food isn't something I think should be banned, but it's worth knowing that no McDonald's is probably better than one McDonald's. One McDonald's is better than 10 McDonald's. There's a sort of a continuum. So I sort of think about it in that way. And I think the paper supports that approach. There isn't a transition point at which it goes from harmless to harmful. There's a little bit incrementally that builds up. And I guess it's up to policymakers rather than scientists to think about what our tolerance level is for harm.
And can I just pick up on that methodology? Because you're talking about gambling harm, but to my understanding, you didn't actually measure gambling harm, you're measuring gambling spend. So is it problematic gambling you were looking at, or was it just a correlation between gambling intensity and the experience of other behavioural indicators of harm, as opposed to, a clinical definition of someone as being experiencing gambling problems?
Yeah, so we didn't use correlations. We used regression tests that controlled for lots of different things. But that's right, we didn't measure a clinical sort of PGSI, for instance, for individuals to see whether it was gambling harm that they were experiencing. What we did is we found things that were indicators of harm in their lives. Some more unambiguously than others. So I think payday loans, defaulting on your mortgage, for instance, are pretty unambiguous, whereas some of the other ones were more grey. And we found that these outcomes were associated with proportion spent on gambling. But looking at gambling harm specifically is something I'm really interested in. And in some follow-up work, we're looking at how you can tie that bank data to PGSI and other measures. So we'll hopefully have an answer for that in the next few months about if those two things are associated.
So one of the things that we've talked about on this seminar series previously, when it comes to looking at more behavioral data, and I think whether that's banking data or whether that's data that comes from inside of a gambling operator, is the opportunity to use that not just as a proxy for a variable like the PGSI, but potentially as a replacement for that type of variable. So, the PGSI, to the extent that it's accurately predicting a clinical diagnosis, would be, somewhere in the range of 80%, depending on whether we're adjusting for sensitivity or specificity. What do you think about that idea as someone that's looked at a very specific type of data? Do you have sort of confidence that that type of pursuit is completely fruitless, or potentially the future solution for being able to identify individuals that might be at different places along the harm spectrum better than the sort of epidemiological tools that we have right now through surveys?
It's a really interesting question, and it's one I'm thinking about a lot, and I'm not sure I have made up my mind on this, and I'd be really interested in, I think a key question for me is the extent to which the two are associated. And I think that there's tremendous value in having these tools that are standardized. And I think so we've been talking about this in the lab here, and we've sort of been talking about it as being potentially like a kind of Rosetta Stone that you can sort of use as a sort of translation tool. So they're both giving you slightly different things. I think the good thing about having a standardized questionnaire is that it's validated, it's consistent, it doesn't depend on, one bank does things one way, one bank does it the other way, or one operator versus another. That sort of translation is very difficult. And it also gives you something that can be compared across time. So my PGSI this year versus next year is probably more comparable than my financial landscape because other things can be moving around. Having said that, I think that there is a tremendous value in being able to have an objective look at how people behave, not just how they say they behave. I personally find it really difficult to recall things that are not provocative or controversial in my life. How much did I spend on petrol last month? What did I think a month ago about topic X? It's quite hard to recall, I think. So I think that one of the things that might be particularly interesting is to see whether financial data can maybe detect things sort of tremoring in the water that aren't looking quite right. So I imagine one of the things I'm interested in testing is thinking about the point at which, and you said about the 80% detection rate, there's a point at which an individual maybe is starting to experiencing things that aren't quite great, but maybe they haven't quite got to the point in their journey where they've been able to self-reflect on it and report in a questionnaire that the problems have arisen. Now, maybe further along in their journey, they would be able to sort of self-reflect because the effect is amplified and it's more aware and more present to them. So one thing I'm really interested in is maybe not financial data as a replacement for these survey-based methods, but actually sort of detecting maybe a subset of people for whom there's a higher likelihood that will notice harm in the future, and maybe being able to kind of triage in that way. But I think what's really powerful is being able to compare the two and see what, in the sort of Venn diagram of the two, what's gained from one method versus the other. And I imagine there'll be a large shaded area in the middle, but each one will have some additional benefits that the other one lacks.
I think that's a really interesting point, and that's actually a study I'm working on at the moment with a wagering operator online to provide customers with a couple of different measures of harm and then match that with behavioral data. Now, we don't have is that context, so we can look at spend and frequency and indicators of potentially more indicators of problematic gambling, things like chasing losses. It's all in the ecosystem of the betting, but we don't have what you do, which is the context of how much they earn, how much they pay on rent, what proportion of their money they're spending, and also what proportion they're spending with other operators. So you're only seeing a piece of the gambling when you're looking at operator data. So I think it's, and we know that just through survey work, there are plenty of people who score on, for example, the PGSI as having problematic gambling, yet also tick the box to say, no, I don't have a gambling problem. So there's some level of disconnect between the self-reported measures. So I'm really interested in that idea of early detection of harms or emerging problems and that continuum, which I think certainly something I'm looking at more often. And then the fact that this was driven by the bank. So I guess I'm curious of your understandings of what is done with this data. What are banks, or what can we do once this information and we start to have this kind of understanding? Are there set levels that are red flags that trigger something? What happens next?
So I, as of 2020, when I left the bank, I can't speak to what's happened since, but I know that there was a clear line that the research was exploratory and really a sort of the bank wanted to kind of donate this evidence base to sort of public understanding. It wasn't designed to affect people's credit risk scores or lending decisions or anything. So it was sort of a closed loop that didn't feed back. And I think that's the right thing to do. But I do think that there are some opportunities for financial institutions to not necessarily use this data in a sort of sinister way, but I've been talking to the behavioural insights team in the UK, also known as the Nudge Unit, about ways in which financial institutions can maybe design platforms that are helpful for individuals. So are there ways in which they can design tools that might encourage people to reflect on the amount they gamble? Now, the bank aren't going to use this to affect them adversely with their financial position, but it might be a really helpful learning tool, just in the way that you have sort of spending guidelines and insights for other types of spending on mobile phone apps. I think that banks are interested in finding ways to use this information just to give a bit more context to consumers as a useful product. And again, I don't know what Lloyd's policy is because I'm no longer there, but a lot of the conversations that I've had in the UK context with the Gambling Review Act white paper coming out in the UK and talking to the Gambling Commission and financial institutions, there's been a really big focus in that paper on thinking about checking affordability, how credit reference agencies might be relevant to this discussion, and ways in which this kind of work can be embedded to protect vulnerable customers. So in our specific piece of work, the focus was just exploratory, purely scientific, but I think that there is a big push and a big appetite in the UK, certainly, I'm not sure about other jurisdictions, but presumably similar, to find ways to have banks really amalgamate the information that they have across providers to protect customers.
Now, on the question of affordability, I wanted to ask you about the variable of interest that you described sort of at the start of this conversation, which was the share of income that people spent on gambling? Is that right?
It was their monthly spend.
Okay, the share of flows. So I know that a lot of people think that affordability matters as far as detecting harms. Would you mind just expanding a little bit on how you were thinking about that problem as you defined this variable? And if there was anything else that you thought about might be a different way to go and why you actually chose that particular measure?
Yeah, it's something that we spent a good deal of time talking about. So before, I mean, we wanted to nail down our measure of gambling before we started any of the analysis so that we wouldn't just be, p hacking. But in our discussions, we thought, well, should it be a dummy for gambled or didn't gamble? But that felt far too crude. We thought about absolute spend in pounds, but that doesn't account for people's ability to spend that money. If you're a high roller going to Vegas and spending thousands, then maybe that's, a drop in the ocean to you. Somebody else, maybe £10 a week is a lot. So, and then we also thought another measure. I'd be interested if what you both think about this, if you think it's a useful measure or not. But we thought maybe about intensity. So, how often are you logging back in to the app and topping up? Because maybe that suggests a lack of foresight. It's probably not a good sign if I log into the same provider 3 times in one night, because presumably I'm thinking, right, I'll just spend this much. And then I'm thinking, oh, hang on, I'm going to, keep going back. That might be a sign of distress. So we did think about that as a potential measure. But ultimately, I think, given that we're dealing with financial data at a bank, they were particularly interested in affordability. And also, given that a lot of our outcomes were looking at the amount people were spending on things, it seemed like a nice sort of compatible measure.
I think it also I really like that approach because it is very unique as well. Because with other data, you can see things like chasing and variability, and I guess that's in frequency. I think is definitely relevant, but also a lack of consistency. So almost a sawtooth pattern has been found where you gamble a lot and then you stop, and it seems like there's a period of abstinence, and then you come back really high. So and unpredictable, as opposed to someone that spends £10 every Saturday, someone who's popping up all over the place on lots of different things. So that, as you say, lack of planned behavior seems more impulsive or lacks controlled. But I think it's really interesting what you've done, because you've taken it to more of an objective measure, because with any sense of variability, you have to then decide, well, how variable does it have to be? Is it how long does the absence have to be? How many sessions during one day is problematic? So I think that one of the difficulties we found with using behavioral data, which has been, other than your paper, mostly from the operator's perspective, is how do you operationalize? We know variability or intensity is problematic, but is it 2 times greater than average, 3 times greater than average, 10 times greater than average only for people who spend above $10,000? So how do you actually put that in place? Whereas what you have is standard across everyone. But there still is that issue of, what proportion of income is potentially problematic. And I was wondering if you've had any thoughts on some of the low risk gambling guidelines that suggest that any more than 1% of income, and I can't remember if it's household or personal as well. So the people get sources of funds from different places, but 1%, where do you see things starting to look problematic? Is there a specific set point or range?
I'm sorry, I was just jotting down because you mentioned a sawtooth effect, and I really like that because that's something we've been talking about a lot, and I've never had a word to describe that before, that sort of variability. So I was just quickly
That is
jotting
from a
that down.
paper, so I'll put that paper in the show notes too, because I didn't invent that one,
Fantastic.
but I'll flick it over. Yeah.
Oh, thanks very much. Yeah, that's something we'll have to talk about more because I'd love to hear about your thoughts about that. But I've completely forgotten what I was going to say. Sorry. I got distracted by the saw
This is so.
tooth.
I was talking about the proportionality. The low risk gambling
Of course.
guidelines say you probably shouldn't spend more than 1%, or on the flip side, it's more if you spend less than 1%, that's usually a safe level.
Yeah.
So, is there a sort of proportionality of spend where you see things starting to look dicey?
It's interesting. We when we were doing the sort of the circulation of the results and talking to policymakers and to the media about the work, they were really interested in us having a cutoff point. And we were really reluctant to suggest that there was a cutoff point. But somewhere in all of these conversations, the conventional idea was that the paper showed that 1 in 4 gamblers experienced harm. And I think that mapped onto maybe 3.5%. So that was the kind of number that people went with. Like I said before, I think it is more of a continuum. So I don't think there's a cutoff point. But certainly if you look at some of the financial plots, it does look as though something is changing at around that 25% of gamblers, which I think mapped onto about 3.5%. So not quite the 1%, but I think that's when things really started to ramp up, with things like people missing their credit card payments and having experience with the bailiffs and things like that are unambiguously bad. So that might be the kind of area that we found in the data as being a potential switching point. But yeah, it's interesting because there are lots of different cutoff points that I've heard in the literature. So it seems to be a bit of an open question, but that was the number a lot of people latched onto from the work that we did.
Okay, so I have a open banking question for you. I'll try to give my understanding of open banking, and then you can correct me, and then follow-up question to that. So as I understand it, basically it's banks with their own APIs that different businesses or individuals can connect to extract financial data about individuals. If I have that roughly correct, my question for you is, we often, when we're talking about from a regulatory standpoint, we want to push a lot of the responsibility onto operators or even others, say corporate stakeholders, maybe financial institutions, as is becoming more popular in the United Kingdom. But I often wonder about, like, what are the opportunities to push more back onto the individual in terms of their ability to manage their own risk through their own data. And in other fields, there's this talk about the idea of bring your own algorithm, where you might be able to adjust or tweak or just almost build entirely, perhaps obviously with other organizations that can provide you with a base model, but the idea of having more control over what it is that you might see on the site. So my question is, for you, do you see an opportunity to use open banking data, perhaps mixed across financial institutions and with gambling operators, as perhaps a more robust solution to predicting risk levels for individuals that allow individuals to control their own algorithm to that end?
It's really interesting. I hadn't thought about people having their own kind of algorithm. It's a really thought-provoking idea. I think what I do think in this space is that so there's been a really seminal paper for me that's come out of a colleague, Nick Chater, in the business school here with George Lowenstein. And it's talking about this issue about generally in policy, the way in which we've approached nudging in behavioral science is to put the onus on the individual and to change their behavior. And the example that they give is climate change. We're all told that we must care about our carbon footprint and that we need to, take responsibility for recycling and whatnot. Now, of course, those things are important, and I would hope that people adopt those practices. But what they point out is that that was something that was promoted by BP. And you might be thinking, well, why would BP want to encourage this? And the reason was that it deflected the attention from their responsibility as an industry, and it's pushing the burden onto the individual who is now responsible. And I think we often see this in, there's a common slogan in the UK, and I'm sure other countries have it, gamble responsibly, the onus being on the individual to gamble responsibly and not be irresponsible. And similarly, drink responsibly, drink aware for the alcohol industry. And I think I think I'm of the opinion that it would be better if we pushed back from that kind of individual responsibility and think more about the choice architecture. So I don't think it's fair that operators are given a burden to understand their customers to such an extent that, say, a bank would, because they just don't have that information, right? If I'm on the app, from what you were saying, Sally, it's really difficult to know if that is affordable for the individual or what the context is of their life outside of the platform. However, I think that there is a balance to be had, and I'd be a bit wary about pushing the responsibility on the individual to sort of find all of the tools and amalgamate all of the information. That being said, I think that there are some really nice opportunities, and the Behavioural Insights team is doing some really interesting stuff in this space to think about how you present to individuals through open banking platforms and the like, playing back to them the information, because I think often if you have an account with an operator over here, you have an account over there, you're topping them up on a semi-regular basis, it's quite difficult to kind of keep track. The mental accounting is quite arduous. So I think that there are definitely tools that could be implemented within financial apps and other apps. But I think my preference would be to find a solution where the choice architecture is more transparent and less playing on behavioural heuristics, rather than the onus being on the consumer to sort of be responsible and do the research.
Yeah, I agree with that. The product and environment have a huge impact on the development of harms and the likelihood that someone does spend more than is affordable to them. So I think it's important that there's a push for that. But I'm also wondering about the responsibility of the banks to have access to data and then to provide that back for customers. There's an increased movement towards what's called activity statements, which are more or less useful, useless, depending on how they're put together. So often they're just a shopping list of like every single bet transaction, which is pretty useless to anybody. But in Australia, there's now a regulated, or anyone that has an active wagering account has to receive a monthly statement in a standard format that very clearly says net wins, net losses. It has, red when you lost. It displays your losses over a period of 6 months, so you can see the difference over time. Again, this is putting the information back in the person's hand to act on. But I was wondering what you thought about the extent to which banks have a responsibility to provide relevant data to individuals to assist them to make the appropriate decisions.
Yeah, it's really challenging because you can imagine that the banks have this rich data that can help their profitability and help them to sort of target customers in an intelligent way and with marketing and whatnot. And one would hope that individuals are sort of getting something back in return for that data. I think increasingly with the boom in sort of the fintech sector, customers are seeing banks in a very different way. So no longer is it the place that will just sort of keep your money safe in the vault, and the friendly advisor that maybe you go and have a chat to once every few years when you want to refinance or remortgage. I think increasingly the consumer is savvy and is shopping around, and they're looking for these added insights that can help them manage their money. And some of those are in the space of gambling, but they could be across a whole spectrum of things. And I think that designing products that can give consumers insight about their finances, about their spending, about their planning, and not just about their financial position at the moment, but sort of touching on that idea of looking across time at their wins and losses versus 6 months ago. I think that's a really nice idea, and I think people are looking for things like that where they can get insight, because I think sometimes your bank can feel, depending on who you bank with and how technologically literate they are, sometimes a bank can feel in the world of social media and large language models and everything is changing. Sometimes a bank can feel quite not so revolutionary. So I think that it's a space where consumers are increasingly asking for more. They're used to this in other parts of their life, things to be a lot more savvy. Maybe it's just the banks that I bank with have not been very advanced. Maybe I'm banking with the wrong banks, but it does feel as though there is a lot of scope there for them to become more advanced and more sophisticated in the way in which they play things back to the consumer. And it's a point at which you really can differentiate yourself from the competitors, I think.
What role do you think banks or other financial institutions do you think they should play in the overall gambling apparatus if you were advising the regulators?
I think it's challenging because the banks are in a really privileged position. They can stitch together an image that no one else can see. The regulator can't see my financial position across lots of products. Neither can the operator. Neither can researchers typically, unless they're accessing this data. I can imagine banks have a few options in how they engage with the regulator. And I can imagine the scenario that they won't want, understandably, is to be cajoled and forced into having to do lots of arduous work to do the research in-house, for instance, and detect individuals. I can see a better scenario for them and a better scenario for the regulator is maybe for there to be a data donation, for instance. So if banks were to give heavily anonymized data, and this has happened in other industries around pensions, around payday loans, Financial Conduct Authority do a lot of this kind of stuff. Banks will give highly anonymized data to the regulator, and then it's for the regulator to find appropriate researchers, and anyone can apply, and so long as they meet these high standards, there is a repository for research so that we can understand where the harms exist, where they don't exist. And I imagine that would be much better for banks than having to employ teams of research, teams of in-house data analysts to crunch all of these numbers. Instead, you might have a scenario where these data are available via the gambling regulators so that the work can be done. And I think that would be something that would be a huge societal benefit to be able to design policy that is evidence-based, but it would be less arduous for banks than having to individually do analysis and then feed back the results of that to the regulator. So I think that would be a great place to start.
I'm aware we're getting close to the end of the hour, and you've been so generous. I still have a long list of questions, Naomi, but I want to turn it back to you and ask you what you're interested in and what you're working on. If there's any call for research you'd like other people, we can only do so much ourselves. Is there anything you'd like to see or questions you'd like answered? Anything you'd like to share from your perspective?
Yeah, sure. So I am very jealous of people that have access to operator data. That's something I've never been able to access. So I have a bunch of things that I think are really interesting in that space. If there was a sort of a magic way to tie up lifestyle outcomes like we had in the bank data somehow to that individual play data, I feel like that would be incredible, because once the money is uploaded onto the app, it really is a black box. We don't know how people are playing, if the money's just sitting there. We can see if somebody cashes out, but we can't see the sort of intensity of what's going on under the hood. So I am really interested in a lot of things in that space. I think that some of the questions that are really interesting me at the moment are around really fleshing out an understanding of the impact that gambling has on society from a broader perspective. So more of kind of the impact on public health. So I'm currently working with the Gambling Commission on a 3-year grant to try and understand how we can implement some of the learnings from the white paper that came out in the UK, and really using financial data to try and unpack some of those questions. So I mentioned that looking at transactional data, this time using open banking data rather than with a specific operator, and looking at then having those individuals complete surveys that we're designing. So looking at whether we can see that markers in people's spending behaviour are associated with increased harm with the PGSI, but also broader things like people's mental health and well-being, their financial levels of comfort. And I'm also really interested in whether we can kind of have a taxonomy of harm that's more structured than what we proposed in the paper. So I don't think you're going to get a single measure of harm, sort of a number. You have a 10, you have a 3, and that captures everything in your life. But I do think that we could maybe have different dimensions, and thinking about ways in which we could do some dimension reduction so that instead of 31 different things, we've got a few specific ones. I'm also interested in thinking about people's transitions into harm, and whether there are ways that we can use machine learning algorithms and clustering techniques to try and understand if there are different sort of characteristics of journeys. And in particular, I'm interested in thinking about ways in which we can look at the kind of chaotic nature and ways in which we can formalize that mathematically. So I've been thinking a lot about gambling entropy as a kind of measure of the kind of chaotic nature of how people are gambling, or whether, like you said, it's that smooth and steady person who will gamble £10 once a week, every week on a Saturday on their team. So I'm trying to think about ways to kind of formalize that, and I guess get a sense of measuring lots of people at scale to get a sense of what the position is at the moment, in this case in the UK, but more broadly in society. So those are some of the questions that I'm thinking about at the moment. Again, using lots of banking data rather than the operator data, which I really wish that I could get my hands on, but that's maybe for the future.
Well, I imagine you're going to have operator data in your hands sooner than later on the path that you're on, because it's quite the blue ocean of opportunity that you are forging ahead in. So it's been fantastic to talk to you today and hear more about this paper and your work more generally. So thank you so much, Naomi, for joining us this week on the TRG seminar series.
Thank you so much. It's been a real pleasure, and you've given me lots of food for thought as well. So I've really enjoyed being able to have this chat with you both.
Well, thank you very much, Naomi. Thank you to Kahlil, and thank you to everyone who is watching. Just to close the circle, the paper I mentioned in relation to sawtooth patterns of gambling was an Italian paper published in International Gambling Studies in 2013. The lead author, or the first author rather, was Nicola Adami, and the paper was called Markers of Unsustainable Gambling for Early Detection of At-Risk Online Gambling. So obviously we've all been working at this for a long time. So thank you again, Naomi, and please everyone join us next week, where we'll be speaking to Laura De Silva, who is Director of Silverfish, which is a firm looking at ESG, sustainability, and we're going to look at the other aspects of risk. We talk a lot about problematic gambling, but there are a whole lot of other risks in the ESG spectrum that we're going to be talking about next week. So please join us for that. Until then, thank you, everybody.